Hi, class. Welcome to the capital asset pricing model. So I think what you'll see here is that this falls out pretty naturally from the modern portfolio theory that we just did in the previous chapter. And so without further ado, let's go ahead and take a look at it. So we are going to cover kind of an example of how you would build a portfolio to help understand this. First off, think about like in project one of the investment project. How did you build your portfolio? Right? You probably just like, oh, buy a little this, buy a little that, buy a little this, right? But if you want to approach it from like a professional's perspective, what we looked in the previous chapter was how to use modern portfolio theory. And what that really came down to in the end is you look at historical returns and standard deviation of all the different things you can invest in, and then you use a computer basically to create a portfolio with the highest Sharpe ratio. And we call that portfolio the optimal risky portfolio. And then we added the risk-free asset and the optimal risky portfolio, and we looked at possible portfolio combinations of those two, and they fell on this straight line we called the capital allocation line, right? And so the point was, you find this optimal risky portfolio, and then you put some type of portfolio together that combines that with the risk-free asset, depending on how much risk you want. And we could go out on margin leverage by borrowing money instead of investing in the risk-free asset, and go out on that capital allocation line beyond, right, the optimal risky portfolio. So, so that's a lot of work, right? Historical returns do you do for the last 10 years, 15, 20, 40 years? And what you're essentially saying then is that you're going to use history to predict what's going to happen in the future. And, you know, while history repeats and stuff, it's maybe we can do a little better, and maybe there's an easier way to do this, and that's what this chapter is about. So whenever science, or especially like economics, looks at a problem and tries to figure out an optimal solution, we start off with simplifying the problem. And then after we come up with a solution for a simplified problem, then we start relaxing some of the assumptions to see how the solution holds up under maybe more realistic conditions like real world. And so that's how this chapter starts. It starts off in the capital asset pricing model theory. It starts making assumptions. And so it assumes things like all the securities that we can invest in are publicly traded. They're easy to get to. Everybody has access to them. We as investors, we all have the same information. I know that's a little bit of a stretch, right? But you kind of have to play along with it and kind of buy into it. And like I said, later on, the assumptions start getting relaxed when people start doing more testing and refinements. All investors have the same holding period. You can borrow money at the risk-free rate, and you can lend money at the risk-free rate. All investors have the same security expectations, meaning we all have the same thoughts about what the market return will be, what the standard deviation will be, and what the correlation coefficients are going to be. And we all try to kind of rationally optimize the return to risk ratio, aka the Sharpe ratio. And we don't worry about taxes, and we don't worry about transaction costs. We assume that's all the same. A little bit of a stretch, but that's kind of what helps us get some kind of solution, because otherwise the problem is just gets a little bit more intractable. So what results out of this? It means that investors all calculate the same optimal risky portfolio, basically, right? And it means that all investors invest in the same portfolio that includes the optimal risky portfolio. And so if all investors buy the same stuff, that means the portfolio of stuff must include everything. Because if they didn't, there would be companies, stocks, bonds that had no investors in them, right? And we know that's not going to happen, right? Everything, someone's going to invest people have to invest in something, because if nobody buys it, it becomes ridiculously cheap, the price falls, and then people will buy it, right? So if you look at the equilibrium outcome of all investors being exactly the same, it means we have the same optimal risky portfolio, and it basically means that this optimal risky portfolio includes the whole universe of stocks and bonds and things that we can invest in. And then what this means then, if this optimal risky portfolio includes everything, that means the inherent risk of any one stock in that portfolio is going to be kind of proportional to how much market risk that stock has. Think about it like this. If you have a portfolio that is the entire market, and you want to know how much risk a particular stock has, it basically depends on how much market risk that stock has. Idiosyncratic risk that we talked about before, the unique risk, is diversified away because we own so much stuff that all we're worried about is market risk. Okay, remember that chart we did a little while back. Here's a kind of a graphical representation of this. So we kind of started off, right, with modern portfolio theory, right? And that was based on this optimal risky portfolio, which we calculated with the Sharpe ratio. Then we start making some assumptions, and basically those assumptions came down to identical investors, and we all have the same information. There's no taxes, so the market's all pretty competitive. And what that gives us is CAPM. So what we're saying in CAPM is that this optimal risky portfolio is the market portfolio. That's the key. You don't have to worry about calculating Sharpe ratios and should you add a little this or add a little that. Just buy everything. That's the market portfolio. And this line then, the capital allocation line, it's going to change name. We're going to call it the capital market line. And it's going to give us the CAPM equation that you did in Finance 300. And interesting thing about this is that after this research was kind of published, kind of a investment industry person, his name's John Bogle. He kind of took this research to heart. And he said, like, how can we do this for the average investor? How can we create, a portfolio that represents the market, at least all the stock market? And so what he did is he saw that, the S&P 500 index, it is pretty much over 95% of the stock market. So you could argue, I know it doesn't have a lot of the other 1,500 small stocks, but essentially it is a big chunk. It is the market. And so he created a mutual fund that did no stock picking at all. All it did was try to emulate the S&P 500 index that kind of represents the U.S. equities market as a whole. and he founded a company called Vanguard. And so that's why if you look at like mutual fund companies, you see Vanguard is one of the biggest because this idea really took off. And if you look at ETFs as well as mutual funds, you'll see most of the money now is in these index funds that track a big component of the market. I know some of them don't have stocks and bonds and stuff like that, but there are some out there that do that. But the vast majority, of the money is in the S&P 500 index. And he wrote this book right here. It's called The Little Book of Common Sense Investing. And there's a website, if you're really into this mantra of, in terms of financial advice, you can check this out. People post questions. I'd say it's pretty common sense. It's not about stock picking the next, what's the next NVIDIA. It's about just kind of like planning smart and looking at it from, a diversified point of view. It's called Boggleheads. Check that out if you want. And you can see people post a lot of questions about how to invest and stuff like that. I think it's some kind of like message board or something like that. And here is, this is the net result of the CAPM, right? We've got used to be the capital allocation line. Now it's called the capital market line. And this optimal risky portfolio is basically the market portfolio, okay? We've got the risk-free asset, just like before in this chart. We've got the returns on the vertical axis, and we've got risk here on the horizontal axis. All right, let's do a couple questions. I'll say the questions kind of repeat basically what we just did on the last chapter, so that's kind of good if you needed some extra practice, because all we did really was change the optimal risky portfolio to the market portfolio, and a lot of these questions about creating portfolios are kind of essentially the same. Okay, so let's take a look at a question here. Let's suppose the risk-free rate's 5%, and the expected, the return and the standard deviation of the market portfolio is going to be 9% return, 20% standard deviation. So a couple questions here. First off, what is the slope of the capital market line, aka the Sharpe ratio, right? And then the second question is, how would you create a portfolio that had a 7% expected return? And what is the standard deviation of that portfolio? So go ahead and pause if you want. And I'm gonna pull up some information here. I'm gonna copy some of this stuff from down below. So first off, with the slope, we're going to use that Sharpe ratio equation, right? And so here's the Sharpe ratio, right? It's going to be the return of whatever portfolio we have minus the risk-free rate. That's this right here. And then we divide that by the standard deviation of the portfolio, and in this case, that's 20%. Okay, so here's the slope, the Sharpe ratio of that market portfolio, 0.2. That's how we would calculate it. And then the next question is, how do we make a portfolio of 7%? Now, I'm going to give you, let's look at a quick way to do this. Check this out. The risk-free, right, has a return of 5%. Right? And we're saying that the return on the market is 9%. And what you want is to combine those two in such a way that the portfolio has a 7% return. You see how we can kind of eyeball that? Because 7% is exactly halfway between 5 and 9. And basically what that means is we put 50% of our money in the risk-free asset and 50% of our money in the market. And that'll give us a portfolio with an expected return of 7%. And so that's going to be our 50-50 portfolio. And I'll do this math so we can just double check that. But then also the standard deviation of this portfolio, right? If you remember, is the weight, how much of our portfolio that's the W, we put in the risky. In this case, risky is the market, times the standard deviation of the market or risky, right? When we have a portfolio that's composed of the risk-free asset and a risky something risky, this is how we calculate the risk on that portfolio. So it ends up being 0.5, right, times 20%, which is the standard deviation of the risky, and that ends up being 0.1. So that's how we would calculate that. Let's take a look at if we were to do some of the math. I'm going to pull up if you remember this equation here. Basically we set the return of our portfolio up to set it equal to 7%, right? And this would be like RF, so that's the weight on the W on the risk-free asset, right? And then this would be the W on the risky, or let's call it the market portfolio, right? But we do know that the sum of those two W's always has to be 1, right? So we could say this. That the weight of the market has to be the same as the weight of 1 minus the weight on the risk-free asset. Okay? So now if we go ahead and solve this equation for WRF, I'm not going to go through the algebra, check that out, but you're going to get 0.5. And so if WRF is 0.5, the weight on the market is going to be 1 minus the weight on the risk-free asset. It's going to be 1 minus 0.5, and so that equals 0.5. So those are our weights, 0.5 and 0.5. And that we kind of did that before by just kind of eyeballing it, which you may not always want to do because, but this is the mathematical way to do it, just using a little algebra. So let's look at the CAPM model a little more specifically. If you remember from Finance 300, this is the CAPM model, right? And if you remember, what it says is that the return on some stock is basically equal to the risk-free rate plus the beta of a stock times what we call the market risk premium. So this right here is the market risk premium. Whenever you hear the term risk premium, it means the amount of return above the risk-free rate. So the market risk premium is the amount of the return from the market. You see the little M right here? The amount of return of the market above the risk-free rate. So it's the return of the market minus the risk-free rate. That's the market risk premium. And you multiply that by beta, and it tells you the expected risk premium on the stock. So now we're saying the expected return on the stock is really just a function of the risk-free rate plus this whole term right here, which represents how the stock moves with respect to the market. And if you have a stock that goes up twice as much as the market, your stock is going to have a return that's twice as big as the market. So look at this. This is what beta equal to. And this whole term here, it basically comes from a regression. It's behind the scenes when you do a linear regression. But it kind of, remember this covariance term for portfolios? And we can substitute in for covariance with this, remember? The correlation coefficient multiplied by the two standard deviations. So the beta equals the covariance between the stock and the market divided by the variance of the market. And if we take the variance and we split it out into standard deviation times standard deviation, it gives us this whole term. And you see, we can cancel this out and we can cancel this out, and now we're left with this. So this is what a beta of a stock equals. It's the correlation coefficient with the market, somewhere between -1 and 1, depending on how closely it moves with the market, multiplied by the standard deviation of the stock, and then divide by the standard deviation of the market. And mathematically, it comes from the regression model when you're calculating coefficients on all your terms. But that's basically CAPM and beta, and this is like the theory behind where it's coming from. You may have noticed, guess what? I'm sparing you several pages of an economics proof that it takes to get here. So be thankful for that. That's something usually it's just in PhD programs where you have to memorize that stuff, and it is awful. Here is the portfolio beta formula. So if you have a couple stocks, what we want to know is, okay, how risky is the portfolio of a couple stocks? And in CAPM, the riskiness of a stock is pretty much just beta. We don't worry about standard deviation anymore, right? Standard deviation is how much a stock goes up and down in total. And if you have a diversified portfolio, remember, you don't have to worry about unique risk. You only worry about market risk. Remember that slide we did that looked like this? This is where we're headed right now. And we said that as you add more and more stocks to our portfolio, call this the number of stocks in a portfolio, right? And this is standard deviation of your portfolio. So it goes from 1 to like 2,000 or something like that. As you keep adding more and more stocks, the portfolio standard deviation goes down, 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 but then it flatlines. So it turns out that this upper part that gets reduced as we diversify a portfolio, that's the one that's called like unique risk. It's the risk that any one stock is going to hurt your portfolio, right? That we get rid of with diversification. This part we can't get rid of because the line flatlines, and that is market risk. We measure market risk not with standard deviation, not with variance, but with beta. So when we go from looking at particular stocks to looking at, oh, now we're going to have a big portfolio of the market, our definition of risk changes. We go from standard deviation to beta. I'm only worried about beta now. But guess what? We can build different big diversified portfolios, And so sometimes we want to know, okay, what's the beta of this portfolio versus the beta of that portfolio? And so this is the equation we use to calculate beta for a portfolio or market risk for a portfolio. It's just the weighted average of all the betas in our portfolio. Well, so guess what? I mean, if we all just believed in CAPM and we all just bought the same stock or group of stocks, the market, there wouldn't be much of a job for stock pickers, right? There wouldn't be much of a job for many hedge funds. And many mutual funds would just like collapse and we'd all go to index funds. Obviously, that's not real world. That's not where we live, right? Because while most of the world, most of the money is in these index funds, there's still a good chunk that are trying to like, kind of beat the market, if you will, right? And so what we're saying, if you're trying to beat the market from the lens of CAPM, what that means is you're trying to get a return that is higher than what CAPM predicts. If you're a stock picker, you must be confident you can pick a stock that beats the market. And mathematically, if you're saying you're going to beat the market, it's not just the average, the market average return, S&P 500. It's this equation, right? So that means if you pick a stock, one stock, and you think you can beat the market, you have to look at the beta for that stock and all this other information. And we're going to calculate the expected return of that stock and compare it to the return you got. And the difference between those will tell us whether or not you actually beat the market. So it's a little more complicated than just saying, oh, did you get a return higher than the S&P 500? No, because what if you wanted to get a return higher than the S&P 500, all you had to do was buy high beta stocks. Because if the market's going up, high beta stocks will go up even higher, right? So if you want to be judged by CAPM, we're going to take into account the beta of your portfolio. And that's what CAPM does. And if you're able to get a return that's different, hopefully higher than what CAPM predicts, we have a special name for that extra return that you get. It's called alpha. And if you're a good stock picker, this alpha, Greek letter alpha, right here, it looks like, it's kind of like this. And we call that alpha. This is the Greek letter for it. It kind of looks like a fish with scissor tail or something. I don't know. That you want a positive alpha. That's what you're looking for. And it just and some of you, if you've hunted around for like stock picks on the internet, you may come across a website called Seeking Alpha, seekingalpha.com. And that website is basically all about like trading tips on kind of like stock tips. I'm sure you could probably go to Reddit now, but Seeking Alpha was around before Reddit. It was around before ChatGPT too. So Seeking Alpha, and so the word Seeking Alpha comes from this. You're looking for positive alpha, not negative alpha. Negative alpha means you're doing worse than what the CAPM model predicts. And even more so than just alpha, sometimes people call it Jensen's alpha. It's just like you write a research paper that does something new that people haven't done before. You sometimes you get your last name associated with it. Just like, remember the Sharpe ratio? Well, it turns out there's a professor something Sharpe, and he's actually he was in the Bay Area over at Stanford. This is Jensen. I think it's Michael Jensen, and he may have been at the University of Minnesota or something like that. Anyway, It's called Jensen's alpha, and we can solve for it, and you get this equation. And so that's how we calculate alpha for a stock. This is the actual return that the stock got, right? And then this part right here is what CAPM predicts. So you take the actual return minus what CAPM predicted for that stock or that portfolio of stocks, and you get alpha. All right, let's look at an example where we have to compare two stocks and see which one did better. So here's the question. Stock XYZ has an expected return of 12% and a beta of 1.0. Stock ABC has an expected return of 13% and a beta of 1.5. The market's expected return is 11% and the risk-free rate's 5%. Okay, so first question, or only question, what stock is a better deal according to CAPM? And you think about this, maybe your first reaction would be to just look at the return. Like if I asked you, which stock should you buy? You'd be like, okay, well, ABC is going to give me a 13% return. And that's better than XYZ, which only has a 12% return, right? That might be, the first reaction. But remember, we always take into account risk. It's not just return, it's also risk. Risk is a measure of how unsure or how confident we are, right? And so we need to take that into account. And so the way to do this is we can use the CAPM model, and we're going to calculate alpha to represent which is a better one. Okay? And why do we look at alpha? Remember, in finance, we can engineer higher returns by going out on margin. We saw that back in the previous chapter. In the previous chapter, we based the decision on the Sharpe ratio. And hedge funds do this all the time. They look for securities that have a high Sharpe ratio, and if they want higher returns, they just borrow money to buy more into it, and they can leverage up their returns, right? Go back and look at chapter 3 when we did the markets. And we looked at, and there's a slide in there that looks at leverage when you go on margin. And it shows you the difference in returns you get if you buy a stock with just your own money versus buying an investment with extra borrowed money. And you see that when you borrow money, right, you can get a much higher return as long as the underlying stock return is positive, right? So you get a really higher return on the positive side, but if the things go bad, you can get a even lower return, right? And so I'm not saying this is something you should do, but this is how, more cutting edge finance looks at it from a mathematical point of view. So why don't we do this? The strategy is here. Let's go ahead and calculate alpha for these two stocks and see which one has the higher alpha. And if we don't like the return, margin. All right, I'm going to go ahead and let me copy some of this stuff down here. I'm going to put it up higher up in the slides, so we can get it a little bigger. So if you're to go calculate it, right? Whoops, sorry about that. All right, so first off, with XYZ, right? We plug it into that equation that we've got, so we know the stock has a return of 0.12. In fact, I should have used the Jensen's alpha equation here. Sorry about that. And then we know the return on the stock is going to be alpha plus whatever CAPM predicts, right? And CAPM is, here's the risk-free rate on the stock, right? Here's alpha. And then we add to it, this is beta, right? And this is the return of the market minus the risk-free rate, right? So this is all CAPM, and we're basically going to solve for this alpha. And I should have just used the Jensen's alpha equation directly from the previous slide, and then wouldn't have to do this. But you solve for it, and you get alpha 0.01, 1%. You do the same thing for stock ABC, and you get an alpha negative 0.01. And so even though this one is a higher return, ABC, it's saying it's not as good of a deal because if you buy that, all you're doing is taking advantage of beta. You're not doing a good job of picking stocks. You're just taking on more market risk. You're getting that extra return because you're taking on more risk. And in finance, we don't give you credit for that. People will have different decisions on how much risk they want to take. And if you just look at the output of the return without factoring in how much risk they took to get that return, you could be left with a false sense of security about the future, right? I mean, think about it. Like, say you looked at two drivers who offered to drive you somewhere, and one driver said, "Oh, whenever I drive, I get there 5 minutes early," and the other driver said, "Oh, I'm there precisely on time." Okay, that's the return part of it. That's what you get, right? And you think, "Oh, let's go with this driver who gets me there early," right? But then let's look at the risk part of it. This driver who gets you there early, let's say they drive 120 miles an hour and they're swerving through traffic the whole time. And this other driver is driving, right at the speed limit or with traffic or something. That's kind of important to know, isn't it? I mean, do you want to take that risk? Because going forward, one of the days you might get in a nasty car accident, right? And so when you're building a portfolio and you have to choose, like, let's say a portfolio manager to invest the portfolio, you want to know, were they just lucky? Did they take a lot of risk to get the high returns they got? Because if they did, those high returns they got may not be reproducible in the future, and they may have like a bad year and all of a sudden you lose everything. You get a driver who looks faster, but then they, bad accident. And so we have to figure out how to take into account risk. With CAPM, we do that by calculating their alpha. All right, suppose the risk premium on the market is 8% with a standard deviation of 22%. What is the risk premium on a portfolio invested 25% in GM and 75% in Ford, assuming they have betas of 1.1 and 1.25? It's a little of a weird question. Let me see here. Basically, what it's asking you is, what is the return of the portfolio minus the risk-free rate? That is the risk premium on the portfolio. So it's kind of asking us to calculate the return on the portfolio, but then also subtract the risk-free rate. That's what it's asking us to do in layman terms. I should have just said that from the beginning, right? Oh well. All right, let's plop this out on the slide here so you can see what I'm talking about. And sorry, this is give me a second here. You know what? It's gonna cover some of this up because it's big. Oh man, oh that's hard to see. Okay, so the risk premium is basically RM minus RF. Sorry, it's hard to see now. So our idea is we're going to use CAPM. This is the CAPM equation, and we're gonna solve for R right here, subtract RF from it. So that means we're just gonna move this RF over to the other side of the equation, and we get this. All right? So the first thing we have to do is let's plug in the information we have, right? And we know that RM minus RF right here is going to be equal to, well, let's check that out. The return of the market's 8%, and the risk-free rate is what? Oh no, it's the risk premium on the market is 8%. I almost messed up. So what it's saying is this whole part here, without giving us the risk-free rate, we can plug in 8% for that, because that's RM minus RF. That's what the risk premium for the market is. So all we're left with now is calculate the beta on the portfolio. So we can use this equation, portfolio beta, right, and plug in the two stocks. We've got, excuse me, 25% invested in GM, and GM has a beta of 1.1, and the 75% is invested in Ford, and Ford has a beta of 1.25. You do the math and we get a beta of 1.21, and so then we just go ahead and plug that in here, and we get the risk premium on this portfolio of 0.097. So that's the beta of the portfolio, and that's the market risk premium. All right, here's a question for you. What is the beta of a portfolio that's comprised of 60% in the market index, S&P 500 portfolio, and 40% in the risk-free asset? So what's the beta of the market portfolio? Remember, beta is how closely like a stock moves with the market. So if we're asking how does the market move with the market, it's like, wow, if I have to dance with myself, I'm in perfect unison with myself, right? So the beta of the market is 1.0. It's perfectly aligned, right? How about the risk-free asset? Well, remember the beta, remember it was equal to the correlation coefficient between the two, so between the market and the risk-free asset, multiplied by the standard deviation of the risk-free, divided by the standard deviation of the market, right? So if we're talking risk-free, right, this goes to 0, right? And so the beta is going to be 0 for the risk-free asset. And so that ends up giving us this equation for the above portfolio. 60% invested in a portfolio with a beta 1, 40% invested in a portfolio beta 0, and we get a 6.6 beta. Another question, which asset is riskier? And let's write these down. So we've got XYZ, and we have ABC. So two stocks, right? And we're going to give two pieces of information. The market correlation, you know, really, I should just say beta there. Let's call it beta. So we've got beta, and we have standard deviation. Okay, so this is standard deviation, Greek letter little s, sigma, all right? And for XYZ, this is going to be 0.5, and standard deviation is 0.3. And then for ABC, we've got a beta of 0.8 and a standard deviation of 0.2. A little of a strange mix there, right? Okay. So we've got those two. So the question is, which is riskier? What do you think? Now, remember, we saw that risk is based on standard deviation. That was the last chapter, right? So based on standard deviation, which one's riskier? It's XYZ, right? Higher standard deviation. But then this chapter, we're like CAPM, we're buying the whole market, investing in all these stocks, tons of stocks, we're fully diversified, we've removed unique risk, right? And now we're only worried about market risk. So now, under the CAPM paradigm, which is riskier? ABC, it's got a higher beta. So the question is, it's a little of a trick question. And so the answer really depends on whether or not you have a fully diversified portfolio. If you're just investing in one thing, you're not diversified, the appropriate measure of risk is standard deviation. But if you've already got a fully diversified portfolio and you're just adding on one more stock, the appropriate measure of risk is beta. Okay, so the answer about which is riskier, it depends whether or not you already have a fully diversified portfolio. That's why, over the last, 50, 60 years, there's always the question about, should you diversify your portfolio with gold? Because historically, gold as an investment is right? But certain periods of history, you see gold shoot up. And very often it's during periods of like high major anxiety, high risk, people worried about, collapsing everything, right? You think about like, I think the 70s with the whole oil crisis we had back then. When else? 2008, 2009, they're worried about the market collapse and the Federal Reserve printing money and getting inflation. And now, more recently, 2025, worries about inflation, but even more so than inflation, central banks in foreign governments moving money out of US dollars into gold. And so gold has been seen as a safe haven in times of like the zombie apocalypse. But so it doesn't necessarily always make sense if you just look at it by itself. But if you look at it in terms of a diversified portfolio, that's when investors start seeing, maybe gold is a nice little spice, kind of like a little salt on something. A little bit of it's pretty good just to diversify in case the worst happens. So that's kind of the way to think about some of this. All right, so here's just a summary of some of the graphical lines that we talked about. First off, we had the capital allocation line, the CAL, right? And that was from the risk-free asset up to the optimal risky portfolio, right? We got RF here, we've got return here, and we've got standard deviation, right? And we had a line here, and this optimal risky portfolio was the tangent line with the efficient frontier, right? And that was a CAL, right? And then we said, okay, let's make this CAL the market portfolio, right? And this CAL becomes the CML, capital market line. Everything's the same thing. All we did was assume that the optimal portfolio is just the market, okay? And that's the CML. The next line, we call it the security market line. And that basically, it's kind of like the two charts we did. It looks at return, right? But instead of using standard deviation for risk, it uses beta, right? CAPM, beta is our appropriate measure for risk. And it just shows you how the return of a stock is going to be dependent on its beta. You tell me the beta for a stock, and I can calculate using the CAPM model what the expected return is going to be. That's the security market line. Not the capital market line for your portfolio, but the security for a specific security using risk as defined by beta to calculate the return. This last line basically is a graphical representation of where beta comes from. So it looks at the return of a particular stock versus the return of the market, and it plots all your historical data, does a best fit line, and the slope of that best fit line is beta. So security characteristic shows you where beta comes from when you do like a regression of a stock versus the market return. So this is the security market line, right? And we said here we're replacing standard deviation with beta. And if you had a beta of 1.0, that's the market, right? Here's M for the market, and that would be the market return. If you have a stock with a higher than 1.0 beta, you follow it up to this pink line, the SML, and it says that CAPM would predict a higher return of 15.6%. And if by chance you're a good stock picker and the stock ends up beating what CAPM predicts, and maybe it plots up here on this chart, any amount of return above what CAPM predicts, 17 instead of 15.6%, we're going to call that alpha. Okay? And it just so happens the slope of this line, it's not the Sharpe ratio, right? The difference here is we're dividing by beta, not standard deviation. When you divide the return of a stock minus the risk-free rate, and then you divide it by beta, you get something called the Trainer ratio. We're not going to use it too much, but FYI. This is the security characteristic line. This is the one that shows you where beta comes from. Okay, this axis is the return of the market minus the risk-free rate. Right, remember the market risk premium in the CAPM, and this is the return of the stock, RI we'll call it, minus the risk-free rate. Okay. So that's the risk premium of the particular stock. And all these little dots are like historical, let's call it monthly returns of this versus this, tracked for every single stock, for a particular stock every month, right? And you got all this data, you track it, you do regression, and you get a best fit line. The slope of this best fit line we call beta. And basically what we just did here is create a line with this equation. Remember this from your, I don't know, your math classes way back when? Y equals mx plus b, right? This is the y-intercept for a line, right? Y-intercept, and this m is the slope. Slope, right? So beta is basically the slope of this line. This is x, this is y, and alpha right here is if there's a y-intercept above. So like if this line went through here instead, this y-intercept term would be equal to alpha. So that's where this stuff comes from. You want to know where the stock comes from, the beta? They do regression. And, or they can do the correlation coefficient, right? Multiplied by the standard deviation of the stock divided by the standard deviation of the market, which is basically what linear regression does. It calculates that for you. So So that's where the beta of a stock comes from. We've got a couple different ways to estimate beta. The one we just looked at, or at least described, is called your regression beta. And we can calculate that in Excel. And basically, we like for every month, we get a data point, right? And then we calculate the return of the stock minus the treasury rate for that month, right? And we get a number, right? And then we calculate the return on like the S&P 500 index minus the treasury bill rate for the month, and we get that, right? And then you go into Excel and you use your data analysis tools, regression, and you tell it that this is your Y variable and this is your X variable column, and you do a regression just like you did in your statistics class. And the output of that is you're going to get the slope of the line and the y-intercept, right? That slope is the beta you get from that. There's also something called adjusted beta, and where that comes from is a while back, people started, after this, they started doing, okay, let's look at really what happens to beta over time. Let's look at, instead of just taking this math by itself, why don't we try to calculate a beta that has some more predictive power about the future based on what we've seen has happened in the past? And they found out calculating this adjusted beta helps improve the predictive powers of the CAPM model by changing the beta that you might calculate doing this. And what it says is you take 2/3 times the regression beta that you calculate up here, and you just average it with 1. Add in 1/3 of just number 1. Because what they found is that betas for companies, like a company's beta, all of a sudden go crazy, but then it goes back closer to 1. It goes crazy, and then it goes back closer to 1. So they found that this method does a slightly better job. Another way to do it is to calculate this bottoms up beta. And it's kind of strange, but it's particularly good for private companies, right? If you remember from Finance 300, you did weighted average cost of capital, perhaps for a company, right? So you have to get cost of equity for a company. You get cost of equity by estimating the CAPM model, right? But what if you have a private company that doesn't have stock? Where do you get the beta? What you can do is use the industry average for public companies and then apply it to your company that you're looking at that might be private. And so you can look that data up and then plug it in here. This is the data you would look up. It's called unlevered proxy beta. It sounds kind of crazy, but basically it's an industry average beta. And one of the things we know with beta, it is directly related to how much debt a company has. The more debt a company has, the more risky it is because they're using leverage to amplify their returns, right? The more leverage you have, the wider the range of the potential outcomes. So what they do is they look at a company, the average industry average beta, but then they adjust it based on the industry average debt to equity ratio. And so what they get then from that is kind of this unlevered beta. And so you take that industry average and you multiply it by the debt to equity ratio for the particular like private company you're looking at. So you kind of re-lever the beta. And that's a way to estimate the beta for a stock, particularly a private company. These are the steps we go through to calculate CAPM beta for a stock. And if we did that, these are the results that we would see. So some of this should hopefully look kind of familiar from when you did your stats class, right? Remember, like adjusted R squared or R squared? That basically tells you how much of the variability in the stock's return we were able to predict using the market return. About 30% in here, right? Is that good or is it bad? CAPM is not perfect. If CAPM was perfect, this would be 1.0. So what it's saying is CAPM is predicting almost 30% of the movement of the stock. Okay, down here the regression estimates the intercept. And the intercept, which we call alpha, right, is almost 0.9%. The slope, which we call beta, is 1.2. But that's not enough, right? Because if you remember, you have to look at like the t-stat, or in finance, we like to use the p-value. That tells you whether or not the estimated intercept or slope term are statistically significant. So, and for us, using p-value, anything below like 0.1, right? So 0.47, that's not below 0.1, so that's insignificant. 0.0 for the beta, that's below 0.1, so that is significant. So what this says is the beta of 1.2, yes, we're going to use that because it's statistically significant from the regression. The alpha of 0.899, that's not statistically significant. So we're not going to use that. Instead, for alpha, we're going to assume 0. That's the null hypothesis, if you remember, right? We assume CAPM works and there is no alpha. That's the null hypothesis, the base assumption. And we assume that beta is 1.0, right? But we know beta is 1.2384 because of our statistical test. But we cannot say with any confidence that alpha is different than 0, so we leave that. So we're saying mathematically testing this stock has a higher than market beta, but it basically performs as predicted by the CAPM model. All right, well, we do have some criticisms of CAPM. Let's take a look back now. Theoretically, all those assumptions we made are kind of crazy, right? We're not all the same investment robots. We're not all thinking about optimizing risk and return. Some of us maybe just buy stocks because we have a hunch. We think this is a great company. I want to buy the stock. We're not thinking about all the other stuff behind it, right? So there are definitely some criticisms of CAPM. That's on the theory side. Empirically, by empirical, I mean going back and testing CAPM to see if it's statistically true. It's not perfect. We know CAPM statistically, you don't want to create an investment strategy based on CAPM. Let me rephrase that. You don't want to try to beat the market by using CAPM because CAPM assumes the market is the best guess we have, right? So that's kind of obvious, right? So CAPM isn't the greatest investment strategy to use to beat the market, but it's a darn good investment strategy to get the market average. And guess what? Historically speaking, most investors, if they try to beat the market, they don't, and they end up doing worse than the market. So doing the average of the market, you actually do pretty darn well. We found that there are other factors that help predict stock returns, and we'll talk about these a little bit more in the next couple chapters. We found that CAPM usually predicts a little bit less than half of a stock's return. We saw that with the R squared, about 0.3. Usually it's below 0.5. If we try to predict returns in the future for one particular stock, just using beta, it's not something you want to bet your money on that you can beat the market doing that. Okay? But as an aggregate, it works pretty well, and you'll see that when we look at that coming up. Here are some of the factors that we found that help predict stock returns beyond just beta. Okay, so here's a couple of them. Inflation. If there's high inflation, typically bonds do horrible. Because think about it, when you invest in bonds, you're locking in returns. And whenever you have inflation, it hurts your returns going forward because it reduces your purchasing power. The nice thing about companies is there are a lot of companies out there that if there's a high inflation, they raise their prices, and so they can cancel out the effects of inflation, right? Not all companies can do that, but some companies can. This is probably going to change a little, but oil prices. When oil prices go down, usually what it means is that we're like in the depths of a recession, and so we found that helps. And then when oil prices have gotten really, really low, for a lot of companies that helps them reduce costs if they're energy intensive companies. Credit spreads. We're going to talk about this more when we get into bonds. But if you look at the difference in yield to maturity on risky debt versus safe debt, it turns out that difference varies over time, and it's related to when we go into recession. So changes in the credit spreads help predict stock returns because bond investors are always worried about, are we going to recession? Are we going to get inflation? And so the bond markets give us some good hint as to where the equity markets are going to go. This is a big one right here. I would say I have it listed as number 4, but it probably should be number 1. Interest rates in general. I mean, if you read the financial news for a couple weeks, or like say a year, you will pretty quickly learn that interest rates are one of the most important factors that investors watch when they're deciding about their portfolios and investing in stocks. In general, when short-term interest rates are getting lower, like right now, this is in 2025, talking about interest rates being dropped. When interest rates and the Fed controls short-term interest rates, when they get lower, it reduces costs for companies, and we tend to see stocks go up. And what this is, the term structure is the difference between short-term and long-term rates. And what we find is that when interest rates in the short term are low, and they're lower than interest rates for the long term, it has that shape of upward sloping yield curve, we call it, because the government is trying to help spur the economy on. So it's dropping short-term interest rates. When we see that, it portends very good things for the stock market. We see small companies, on average, over long periods of time, have higher returns than big companies. We think that's because there's a penalty for being a small company. And that penalty is when they go into recession, small company stocks, because they had trouble getting financing from banks to stay afloat. But then in good times, those small companies just go up a little faster than some of the big companies. And then we see the PE ratio has some predictive power. So very expensive stocks, ironically, tend to do worse than cheap stocks based on PE ratio. But this is not a perfect measure, because if you look at the last 10 years, it hasn't worked out that way. The last 10 years, the stock market returns have been pretty much due to like the Magnificent Seven, So these are factors that have been shown to help predict stock returns, but they're not perfect. And we'll get into these in a little bit more detail. Here's an example of one particular model that tried to improve upon the CAPM model. And I know this can look a little bit strange here, but let me show you this. This right here, based on these variables and the nomenclature they use, what I just put the square around is the CAPM model, okay? That is the CAPM. And so when financial researchers try to improve upon the CAPM, which uses the market risk premium, CAPM, and it uses the beta of whatever portfolio you have invested in, right? And when it uses that, what we do is we add on additional pieces of information to the regression. And so one factor that seems to have helped is company size. And this is called SMB, stands for small minus big. So the difference in returns between small stocks and big stocks. And we find that this helps predict stock returns for some stocks. The other one is high minus low, HML. And that is basically, in this case, it's based on the book to market ratio. Kind of similar but different than the PE ratio. It tells you how expensive a stock is. And it turns out this book to market or PE ratio, how expensive a stock is, plus how big the stock is, help improve CAPM. Not a huge amount, but a little. So let me show you this right here. Do you see right here? It says single index regression. That is CAPM. It's using a single number, the market return, to predict what's going to happen. And this right here represents the Fama-French three-factor model. I think they got a Nobel Prize out of this. So the three factors are: one, the market from CAPM; two, we call it the size factor, that's this SMB; and three, the book to market ratio, which is kind of like a growth factor, some ways to think about it. Because high PE stocks, high priced earnings, or low book to market ratio stocks, we'll talk about this more later, they tend to be growth stocks. So you can think of it as the size factor and the growth factor. Sometimes people call it the value factor. Value, it's like it compares the two. Cheap stocks, which is value, versus growth stocks, which are expensive. Cheap versus expensive, value versus growth. That's what it's calculating. And so here are the results. Look, adjusted R squared. That tells you how good the model does at predicting the returns. So for CAPM, 0.27, you see that? Doesn't sound so great. So Nobel Prize, add a couple more factors on it, and guess what you get? Now we're at 0.32. Not a huge, maybe 20% better. It's not earth-shattering, and we have, guess what? We have four factors models. In fact, I just use a four-factor model to gauge some tests that I did, and that adds these factors plus another factor called momentum, where it looks at historical returns, being able to predict future returns. So winners over the last 6 months tend to be winners over the following 6 months. Anyway, I just bring that up to show you that there are more and more factor models. In fact, if you heard the term kitchen sink, throw everything you can in the kitchen sink, including the kitchen sink, use everything you got So we've got 40 factor models, 50 factor models, you name it. But CAPM, yeah, CAPM stinks. It's not that great, but guess what? It's still the most significant factor when you're looking at predicting returns. It's not great, but it's still the biggest factor by itself. So when you invest in a portfolio, how the market does is still a big deal. Okay, that's the net outcome of this. All right, let's end up with a question here. Based on historical data, what do betas do? Are they always close to zero? Are they constant over time? Are they always greater than 1? Or do they seem to regress toward 1 over time? This was that adjusted beta, remember? I think it was actually developed by Merrill Lynch. Or now they're called Merrill. It's D. So if you look at a beta for a company, you'll see over time, and it makes sense. They get closer to 1 because think about it, as companies get bigger and bigger and bigger, they become closer and closer to the market, right? Next question, final question. According to the CAPM, a security with a blank, negative alpha is considered a good buy. Positive alpha is considered overpriced. Positive alpha is considered underpriced, or zero alpha is considered a good buy. Right? Seeking alpha, you want positive alpha. So positive alpha is good, negative alpha is bad. All right? So let's look at our possibilities here. Negative alpha is good buy? No, that's not it. Negative alpha is a bad buy. Positive alpha is overpriced? No. Positive alpha means the stock is actually priced too low, and it's going to compensate and get back up to where it should be, and that's what gives you your positive alpha. So it's underpriced actually. Positive alpha is considered underpriced. That's it. Zero alpha is considered a good buy. It's neutral, right? So the answer there would be C. All right, that's the end of this chapter, and I'll talk to you guys later.